I've changed the title a little bit because since we did this, so many things have happened. We're in just the 92nd day of his term, and we've had tariff discussions, DOGE, deportations, and there are some positives coming. He just started with the negatives. It's sort of not really what I would have done. So I'm going to start with talking about what he's doing that might affect everyone in this room, and then go from there to talk about the real estate outlook that we see, mainly apartments, office buildings, and for sale single family. There's so much to say. We just had our meeting. As John knows, we have meetings twice a year at the Fisher Center where people contribute to us, and we had 305 people come to our Pebble Beach meeting. We started with 30 people, and now everyone wants to know what's going to happen. We don't know, but we're going to give you some scenarios. So let me just start with the policies that are beginning to be implemented. And these are the negative ones. So I'm going to give you the positive ones next, but since he started with the negative, we'll start with the negative. Having done a lot of work in Washington, what's going on with the Department of Government Efficiency, DOGE, is basically deconstructing the federal government we known it. It's completely not just cutting a few people. It's massive restructuring, closing departments, closing agencies, and it's how big is it going to be? 75,000 people have already taken this early retirement, and another 200,000 are on the chopping block. So this is massive. So if you have a chance to get rid of your Washington, D.C. real estate, it's probably too late, but it's going to be a big problem. It already is in some of the markets. They're 20% vacant, so it's a big problem. And he's dissolving major agencies, cutting in half things like CDC, National Science Foundation, NIH, NASA. No one's really exempt from this. And of course, we'll see there's a lot of lawsuits going on, but this is a massive component. But no one seemed to worry. I mean, people in government worried about it, but this wasn't the big thing. The big thing that's affected markets in the last month is the tariff stuff. As you know, April 2nd was Liberation Day, and I'm going to show you the details of that, but it's being wielded as a weapon now. He's backed off a week later, but we already have tariffs, 10% on everything we import. That's still there. He hasn't changed that. We have 25% tariffs on auto, steel, and aluminum imports, and he hasn't changed that. And of course, we have retaliatory tariffs, beginning with China, even though they might move that back. But he's using this as a tool, and he's felt for a long time that we're being taken advantage of. And there's some truth to that, especially with China and some other places. So remember, everything he's saying, there is some truth to his excesses in government. All that's partly true, but he's taken a sledgehammer to do this stuff rather than a scalpel. On immigration, I'm going to talk a lot about that, but you may not know that 45% of our population growth year in and year out for the last 2 decades has come from legal immigration to the U.S. It's a vital part of our growth. Our universities, of course, benefit, agriculture, tech, construction, and he's had a negative view of that for some time. So we're going to show you those numbers. Directly affecting Berkeley, I'm on the advisory boards here and also on the UCSF Medical School Advisory Board. The defunding so far has been focused on Ivy League schools, Harvard, Princeton, Columbia. I was a professor at Princeton. I was at Harvard for some time. And he's really focusing on the science side, which unfortunately, those are the most conservative faculty members. He's not going after the other things, but he has to be in his bonnet and led by his close buddy, Stephen Miller. It's pretty scary. Robert Kennedy scares me even more because healthcare, that's where the big cuts are coming. Our medical schools are going to be affected, everyone in a big negative way. He's also deregulating industry that probably should be deregulated, but he's doing it by firing, changing appointments. Financial institutions, I think all of our financial institutions are feeling maybe it'll be a little bit better, but so far it's been worse. He's also stopped enforcement of the Foreign Corrupt Practices Act. That means we can bribe people again to get business. And that's not something that's so good. Also, oil is back. Fossil fuels are back, and green and wind and everything else is not a priority, and he's defunding a lot of that. So these are the negatives. There are positives. The big one is, I think the tax law that we passed in 2017 is going to be extended. Congress is working on that now. He's also proposed excluding tips, Social Security, and overtime from income taxes. And there's some rationale for that. He's also going to increase the state and local income tax deduction limitation. You may not know, but it's limited to $10,000 deduction of state and local taxes from your federal returns. There's talk of moving that up to 25 or even bigger numbers. So that tax stuff is in process. The problem is it's going to keep the deficit in the $2 trillion range. And that's hard to finance that on a regular basis. So that's going to put pressure on interest rates. On foreign policy, there's so much to talk about there, but I won't. I'm not a political scientist, but we're looking at our enemies as our friends and our friends as our enemies. Doesn't make a lot of sense. On housing, that's my specialty, housing and commercial real estate. He's already proposed a 50% reduction in HUD and FHA. Those are big, important programs, especially for multifamily housing and low and moderate income housing. On the positive side, he's proposed an expansion of something called opportunity zones. Some of you may have invested in those. That was proposed and put in place in 2017. And that's a big positive. It's actually produced over 1,000 units in Berkeley, which means you have this tax advantage if you invest your capital gains outside of real estate in a real estate investment pool in these geographic areas. If you hold it for 7 to 10 years, you pay no income taxes. So there's talk of increasing that dramatically. And finally, some of you who are in the housing market know Fannie and Freddie are two critical parts. Roughly 70% of all single-family housing goes through these agencies. He's talked about privatizing them. They were private in 2008 during the financial crisis. They were taken over by the government. On presidential powers, there's a whole bunch of things there, whether it be law firm issues, national security, the people he's put in place to run these things. I don't know them personally. Kristi Noem, you see her on TV, she scares me. I don't want to go to El Salvador. She did with her gun. But, the fact that she killed her dog and goat, that's not really the type of people I want running the country. Major law firms, including one that I work with, have all offered now under threat to do pro bono work, about $100 million each for him. We'll see how that works out. And his attacks on the Fed, last week he did that, and then he stopped again. He said he was going to remove Powell and try to change the Fed to give it easier monetary policy. He's now pulled that back, but knowing him, you don't know what's going to happen next. So the effect of all this is huge turmoil. You've seen the turmoil in financial markets. All major companies are pulling their forecasts going forward. We've had a big stock rebound last week, but as you know, the previous 2 weeks, a big pullback. So we don't know, a lot of uncertainty. Uncertainty is something that companies hate. And of course, we shouldn't be doing this, but it's his nature. And the people he's appointed are in that situation. I only know one of them personally. His name is Howard Lutnick. He's the Department of Commerce Secretary, and I know him well. He was trying to buy our consulting firm, and in that negotiation, he was great. It didn't happen because we had COVID, but he did pay all the legal expenses, but he seems to be on board with everything Trump's saying. So what does all this mean for everyone in the audience here? Well, the big news is whether we postpone some of it, but tariff levels are going to be the highest level that we've had since the 1930s. And you remember what happened then. It was one of the things that caused the Great Depression. So almost uniformly, every economist, except Peter Navarro, who's his head of this area, I don't even know how he got the job. He went to jail, and he came out of jail, and Trump hired him immediately. So Trump didn't get a chance to get jail. But 20% is a pretty steep tariff. It's going to raise prices, and the question is it a one-time effect, or will it be ongoing and lead to a price spiral? But we do have a problem. So I have to give the credit. We do have $1.2 trillion trade imbalance. That's in goods. We also have a trade surplus in services. So you need to offset that. But this has been growing for the last 2 decades. About the benefit of this is we get cheap goods. It's kept inflation down in the U.S. And we also get the money back. We spend the money overseas, and the money has to be recycled. And the money has been recycled until the last 3 months. The dollar has been very strong, so it's been a big benefit for us. The work that I did not do for Trump, but almost did, he wanted the money for people to buy in his buildings, condos and other things, or finance his projects. So he seems to have forgotten that part, that he's been a beneficiary of this financial flow. But the numbers are big, and China is the biggest one. It's $260 billion trade imbalance. This is Canada and Mexico, also pretty big, Mexico especially. A lot of companies move their production to Mexico so to be part of NAFTA. EU, it's $160 billion. So his view is they should try to balance this. It should be balanced. It's not the view of hardly any economist, but it is an issue. The dollar has weakened under Trump. It's weakened 6, 7, 8%, 10%, but was very strong before this. We were the reserve currency. People wanted to invest here, wanted to invest in treasuries. So the 5 to 10% devaluation of the dollar has almost offset the tariff increase so far. So that's why we haven't seen much effect yet. And the beneficiary of this, of course, this instability is gold. Gold has surged in value, as you know. But let's take a step back. How big is this? Well, trade used to be about 5% of our economy, and the last 20 years it's moved up. We have somewhere between 10 and 15% of our economy is involved with trade. But 51% of the earnings of the S&P 500 come from offshore groups, the sales they make offshore. So it's destabilized the stock market and corporate valuations. And there's an uncertainty index that's put out by the various groups. And until the last week, this was the highest level of uncertainty we've had since the beginning of COVID. You remember that first month, we shut everything down, huge uncertainty. This is much worse from an uncertainty point of view, and it shows up in all the earnings conference calls we're hearing. So where are we today? So Trump inherited a great economy. We had 166,000 jobs created a month in 2024. Unemployment rate was 4.1%. Consumer confidence had been strong. And GDP growth had been 2 to 3%. It was really good. So now we've got the sentiment indicators. The last 3 months, we just got the March numbers on Friday, are plunging to recession levels. GDP number is probably going to be negative in the first quarter. Inflation so far has remained tame, but we haven't seen the effect of tariffs yet. And that's the big question. Does inflation stay in the 2.5% to 3% range? Remember, the target is 2% from the Fed, or does it accelerate to 4 or 5% over the course of the next 6 months because of tariffs? So we don't know the answer, but my guess is it'll be higher, probably 3.5% to 4%, and that's going to make the Fed not want to lower rates further. As you know, the Fed has lowered rates 100 basis points since last September, but they're on hold at the moment because they don't know, is the economy going into recession? Is it going to have acceleration of inflation? Is it become embedded in the economy? From a real estate point of view, credit has become more available, not in the last month, but before that, it became more available in the last 3 or 4 months. Banks wanted to increase their lending, and you could buy a piece of real estate that was selling at cap rates of 3.5%, 4%, all of a sudden 5 to 6%. So it was, and I still think it's a good time to be a buyer. Unfortunately, there's still issues in the office sector. Everyone in this room knows you have to go to the office 5 days a week, but you're not. San Francisco has the lowest percentage of people going to the office on a typical day, 42%. New York is 75%. Texas is 80%. But we just don't seem to want to go back. However, the federal government now wants everyone in every day. 4 days a week from the city of San Francisco. They postponed that until September. We work with a client, Amazon, 5 days a week. So people are going to be going back to the office. But the uncertainty has created a lot of weak activity. So everyone's waiting, they're on hold, and don't know quite what to do. So many of you, I don't think many of you were here when I was teaching, but if you did take my course, you knew I always gave the one scenario. I knew what was going to happen. And in this very room, I remember 4 or 5 times having big sessions. We brought our great economist we had at Haas, and I was able to, in advance, see the recession coming in 2000. We were 3 or 4 months, 5 months ahead of everybody else. In 2007, we saw that coming, and of course, that was the worst recession we've had since World War II. 2020, I gave the speech on February 1st for the San Francisco Business Times and said, China's shut down January 24th. Can't be much longer that we're not going to have the same thing. It happened a month later. So this time, I usually would not do this, but I have no choice. The base case, which until Trump was 70%, is the recovery would continue. We'd add 150,000 jobs a month. We'd have interest rates come down a little bit more on the short end. The 10-year bond stuck around 450. It's, I think, 425 today. And an acceleration of inflation from 2.5, where it's been recently, backed up to 3.5. But still, that was the base case, and that was 70%. I've now reduced it to 40%, and I hope that's true. But we've had to add what we call the Trump recession. And we're going to give it, he's going to have to live with that for the next 1,000 years. He'd like to live that long too. But the Trump recession, a real recession, I think it's already begun. And when the Fed sees that actual recession, I think they will cut rates. We had Mary Daly, who's head of the San Francisco Fed, speak at our conference at Pebble Beach last week. And she was very careful to say, we're waiting and watching. Chairman Powell says the same thing. But if we do get a recession and they do cut rates, the long bond would go back to 3%. It's, again, 4.25 today. But I think the worst case would be the middle one, stagflation, that we get recession and inflation. Inflation because of the tariffs and passing it on in terms of wages. Interest rates go up in that scenario and we get no growth. So that would be, I think, the worst scenario for people in business. So I hate to say this, but I don't know. I guarantee you Trump doesn't know. And his whole economic team hope for the right, but they really don't know what's going to happen. So what does all this mean for what we look at? Well, we could have this tariff-induced recession or stagflation. For real estate, the big thing that would happen if we put the tariffs in place, construction costs will go up 5 to 10% because materials, we import lumber, gypsum, lots of things from overseas. And labor shortages, if we do deport 1 million or 2 million people, 20% of the construction labor force are undocumented immigrants. Same thing is true for hospitality, for agriculture, so that's a big issue. If we get a recession, the good thing is we get lower interest rates, but weak demand is the worst problem. The biggest type of real estate that's at risk here is actually warehouses. Warehouses at the ports have boomed. We had very low vacancy rates at all our ports because imports were booming for the last really 10 years, but certainly the last 3 or 4 years. If imports decline 20 or 30%, there'll be a lot of empty space. Also, real estate is a small part of people's portfolio. Pension funds have between, I'd say 5 and 15% of their portfolio in real estate. If stock prices go back down again, another 20% or so, there'll be less money for real estate as well. And I do worry that consumers are on tenterhooks. This is not just a corporate recession, but consumers, especially low-end consumers, are especially hurt. I saw this morning on CNN, high-end consumers, because they have so much stock investments, are also feeling the same thing. So I think we're almost there, but he changes his mind, so we don't really know. So what do you do with the money that you earned after leaving Haas. I know we have a number of very wealthy people in the room here. Besides giving back to Haas, we really appreciate it. What would I do with the excess money that you now have that you can spend? Well, I think buying real estate as an investment could be the best investment environment since the early 90s. You can buy almost everything except a data center at big discounts to what it costs to build. Office buildings in San Francisco, there have been 14 buildings that have changed hands. We have helped on 4 of them. People bought them $200 to $300 a square foot. Cost $1,000 a square foot to build them. So you know at some point the values have to go back up before you get any new building again. And real estate credit is available today, especially for industrial apartments and through mortgage-backed securities. But if you have to borrow at 5 to 6%, the going-in cap rate is also 5 to 6%. So you don't have positive leverage, you might have negative leverage. But I think mortgage debt will come down as Treasury debt comes down in terms of rates, and you can buy stuff 20 to 30, 40% cheaper than you could just 2.5, 3 years ago. And eventually, we're not going to build anything new. We're going to stop building until we get demand back up and fill that space. So I'll give you an example. Berkeley never had a vacancy rate more than 2%. The vacancy rate on apartments is 10% in Berkeley today. They built a lot of new apartments because of the opportunity zones. So we helped one group buy buildings that cost $500,000 a unit to build. They bought it for $320,000 from a bank. So that's really the opportunities. Get stuff from banks or mortgage-backed securities, other things at nice discounts to the real estate value. If you don't want to actually own the real estate directly, real estate investment trust. There's about basically $1 trillion of them traded in the marketplace, and they're selling between 20 and 60% discount to the underlying real estate. So that's almost, I hate to say, there's no such thing as a no-brainer, because it takes a big brain to figure that one out. But that was my business for a long time. I luckily sold that company, but we made a lot of money for endowments and the like. So now's the time to do that again. A lot of volatility, though. Everything, the volatility is huge. So I know we've got about another half an hour. I just want to talk a little bit about where we think things are. So we track job growth. Job growth fills real estate. Office buildings normally, it fills real estate. Apartments for sure. But every type of real estate is jobs. And the latest job numbers came out in March. The March job numbers came out, I think it was last week ago Friday. We added 209,000 jobs. We've been adding about 150,000 jobs a month last year, 130, 150. And that is really strong job creation, especially in leisure and hospitality, healthcare, construction. But the sector that's been weak, and I know many in the audience, I saw where you come from, are in the tech area. Tech has been weak. And we overhired during COVID, and now those jobs are still not strong. But we've added, if you look at the numbers cumulatively, we've added 6 million jobs in this recovery. The Bay Area is flat. We have not added those jobs, but everywhere else has added lots of jobs. And the unemployment rate is 4.1%. The Bay Area is just about the same. But this is full employment, 4.1, 4.2%. The Bay Area had a spurt of layoffs during COVID, and then we got back most of those jobs the year after. But we now, the last 2 years have been basically flat. Layoffs in some of the tech areas, growth in some of the other areas, but we've not got that consistent growth that we've had. So it doesn't feel like recovery in the full sense. And I look at this very carefully. We break it down by sector. And this just shows you the year-over-year growth in San Francisco. So San Francisco is San Francisco, Marin, and San Mateo counties. That's the San Francisco metropolitan area. We're down about 3,000, 4,000 jobs. Unemployment rate 3.7%. But we're about to see big cutbacks in the government side. And I worry that that's going to be at least one of the weakest spots in the whole job environment. Trade, We're so dependent on foreign trade here. Again, that's going to make us weaker. Right now, as a snapshot, we feel good, but that we may be on the cusp of that downturn. Silicon Valley, which is Santa Clara County, has actually done better, added about 4,000 jobs, and bringing people back to the office again. Again, the tech sector, called information services, has been the weakest area there. We work with Google, Salesforce. They're kindly all members of our Fisher Center. We do consulting with Sergey Brin, those various different people. They think we're at bottom. AI is going to be the big mover. I think we had a session on that either this morning or this afternoon. They're accounted for 40% of the new leases in San Francisco. I've been using it. I thought it maybe write my papers for me. It doesn't quite work that way yet, but hopefully it might at some point. Maybe at some point we'll have an AI person giving the speech here. But one of my workers is an AI freak, and he created a video of me with AI. It was really good. I thought about maybe using that with my clients. It was to a song. So it's here, and it's important, and huge investment in data centers to support AI. We'll see. Is it a breakthrough as big as the internet? We don't know yet. And lastly, the East Bay, which is Contra Costa County and Alameda County, has had the most growth. But you can see it's not been where you really want it. It's education and healthcare services. And those are important things, but they're all have hiring freezes now. So that isn't going to be big going forward, especially with the cutbacks we're seeing out of federal funding for medical research. Massive cuts coming there. A big, as you know, what would I call it, a focus, a boogeyman, is international migration for President Trump. It comes partly from him, but it comes from a guy you may not know, Stephen Miller, Californian. For some reason, he has huge influence on this, and he is extremely negative on international migration. As I said, prior to COVID, roughly 45% of all population growth in the U.S. came from the great people come from around the world. In the last 3 years, up until last May, we had an amnesty program letting people in the country from places like Ukraine, Haiti, other places where they were being pushed out, and they came into the country. And we had probably 4.5 million people, more than expected. I wish that we basically had a more reasonable policy, but unfortunately, we have not been able to get that done. The last time we had immigration reform was under Ronald Reagan. Hard to believe, but that's the last time. We almost had it under Bush, but again, some of the people, anti-immigrant people, which are both on the left and right, by the way, both sides, killed it. So what we're doing now, this source of population growth has stopped. Legal immigration has essentially stopped, and we're on the beginning of this deportation program. Is it more rhetoric, or is it actually going to happen? I'm afraid it might actually happen. And if you have a chance to watch, you can't avoid it, watch the Christy Nomad's, her ads on TV. It says, if you don't have full documentation, leave now. Not what we want to say to people at all. Certainly not good for any of our education institutions or our industry. We've been great beneficiaries of this. But again, we'll have to see what actually happens. The Bay Area has had consistent population growth until the Great Recession. But look what happened during COVID. Lots of people moved out to Texas. Companies moved out to other areas. This is a big number. It was much worse than during the recession that we've had previously. So this is a big issue. It's positive again, but we're just barely breaking even. Again, Silicon Valley is where lots of people go because the jobs are there. Contra Costa. San Francisco has positive population growth again, and that's why rents are going up again. Apartments are full. So this is an important part of the Bay Area's success. And the question is, will the targeting of this administration be at one of our big strengths and stop this? Inflation As you know, inflation hit a big spike during COVID, hit 9% annual rate. In 2022, the actual annual number was 7.1, but it hit 9%. But we still have 2.5% to 3% inflation today. The Bay Area, you can see, is right on target, 2.7%. Labor market's still pretty strong, wage inflation. Housing decline, housing deflation is over. We have housing inflation again. But the big question mark is tariffs. Is that going to be a one-time event, 10%? So how does that affect that portion of the things we import? I don't know. The Fed doesn't know, but it's going to be more inflation is our best guess. You can see we have forecasted 3.5% up from 2.5%. The Fed in that environment probably doesn't cut rates very much, but it doesn't raise rates either. Could it be a bigger spike? Depends on retaliatory tariffs and the like. The one part of inflation that's still above normal is wage inflation, running about 4%, and we have had, for the last decade, subdued inflation. During the recession, it was 2%, then it was 3%, we got as high as almost 7%, and now it's running about 4%. In the real estate industry, we had a huge surge during COVID, a 30% increase in construction costs, and now it's very modest. But again, we're dependent on labor, and if we deport people who would be working in the industry, that isn't good. And of course, if we have lumber, steel, gypsum, all subject to tariffs, we could see another spike here. If you own existing assets, that's actually a good thing. It means that no one's going to build something new until you get an increase in rents to a level that supports that investment. So it actually helps existing assets, cuts down development activity. Oil, the wild card here. What does oil look like? Well, oil has actually come down a lot with the last month's activities, Liberation Day. We're producing record levels of oil in the U.S. He wants more of that. He doesn't believe in wind power. He's got this real fetish about windmills. He thinks they kill the birds, and he cares about birds. He said this in his speeches. But it really is all about Palm Springs turned down a Trump casino. And as he went there a number of times, he saw these windmills, so he blames them on that. It's just, well, I won't say anymore. You haven't met him. You don't want to. This is probably the biggest worry. A lot of the soft indicators on the economy have plunged in the last 2 months. Consumer confidence plunged in March. The April numbers came out on Friday, plunged again. We're at the lowest levels we've been since the Great Recession and since COVID. So if people pull back on spending, if companies hold back on things, if we get tariffs, I think that it's a setup for at least beginning of a recession. And people don't feel good. The yellow line shows you that. The yellow line is they don't feel good because prices cumulatively have gone up a lot in the last 4 years. Last year, inflation was 2.5%. It wasn't bad. But people don't know that. They know that rents are up 30 to 40%. Rents are up almost everywhere but the Bay Area, 40%, 30, 40%. And food prices are up 20%. So people feel bad. That's why we had the election the way it was. Biden-Harris didn't really talk about the fact that inflation was not done. It's the cumulative inflation that matters. And it shows up in things like auto delinquencies. They're up, auto loan delinquencies. Credit card delinquencies are up. So we are seeing, before the Trump effects, negative numbers. And of course, the main thing that we look at in real estate a lot is interest rates. So you can see the volatility in rates. So the last decade, we had rates suppressed substantially since 2008. The red line is the 3-month Treasury bill. It was zero for 7 years. It went back to 2.5. It's Treasury bills, so short-term rates. During COVID, it went back to zero again. And then the Fed raised rates to roughly 5.25%, 5.5%. They moved it back down to, it's now 4.33. The 100 basis point cuts are ready. The expectation in the market as of Friday was another maybe 2 cuts in rates this year. Mary Daly, who again is the San Francisco Fed, person reiterated, that's the consensus estimate, but we have to wait and see what the data looks like. The 10-year bond has been very volatile. It hit 480, I'd say about 4 weeks ago. It then went down after Liberation Day to 388, went back up recently to 450. This slide was prepared a week ago, and it was 440. It's now today 425. So 10-year bond is the rate that corporations use to look at what their borrowing costs are going to be, and real estate, again, 150 basis points above that. So this rate is very important. It's very volatile. But we have an upward sloping yield curve again. And you can see this is the difference between the 10-year bond and the Treasury bill rate. Almost always, when we have a negative spread, it is the short rates higher than the long rate, money is tight, and we get a recession. Every time. Didn't happen this time, but maybe it's about to happen. So we'll have to wait and see, but yield curve is now upward sloping. And then every quarter, the Fed tells us what they're going to think about doing. They give us the short rate. What short rate do we expect to see? So each of these dots is a person. So Mary Daly is a dot here, San Francisco Fed, and there are 19 people who give their forecast once a quarter. This is each dot. So the consensus is that rates, which are running again 4.25 to 4.5 today, move down by roughly 50 basis points this year, and then move down again. Orange is the median, to 3% in the long run. The blue line is what the market thinks. The market thinks they don't get much below 3.75. But really, we don't know. If we get a recession, they move more dramatically. The Fed moves. Remember, it's a vote of the Federal Reserve Board. It happens every 6 weeks. But we don't really know. If we get a spurt of inflation and we still get a strong economy, the stagflation, we might see higher rates as well as inflation. My best guess is down somewhat, because the recession is looking more likely every time he talks. But he says things out of different ways. You don't really know what he's going to tell us, and he doesn't control it. And Powell is certainly not an acolyte of Trump. The other big thing going on that none of you probably focus on is something called quantitative easing or quantitative tightening. That is, the Fed normally did not do this, but beginning in 2008, they expanded their balance sheet from $1 trillion to $4.5 trillion. They flushed a lot of money into the system, to the banking system, to get us out of the recession. And then during COVID, they moved the balance sheet to $9 trillion. It poured money into the system. So about 2 weeks of crisis, and all of a sudden, the system was flush with money. They've now been reducing it using quantitative tightening. That is, they're reducing their holdings of mortgage-backed securities, residential mortgage-backed securities, and Treasury bonds and bills. We're down to $6.6 trillion now, and my guess is they're almost done reducing the balance sheet. They've reduced their Treasury, taking back only $5 trillion a month, $5 billion a month from $60 billion a month. So they're removing that extra stimulus. They're almost done with this, I think. They'll probably announce that in the next few months. They've already announced the reduction in their Treasury reductions. But the big issue is the deficit. And Doge is not going to reduce it very much. We still think it's going to be $2.5 trillion. That is 6 to 8% of GDP. And that's the problem. We're doing that. Germany's doing that. The whole world is doing that. And that's why it's very hard for interest rates on the long end to come down much. We're borrowing a lot of money to keep the economy going. Where should we be today with the full employment economy? Well, look at that in Bill Clinton's era. We had a budget surplus. Was it because Clinton believed that? Not really, but Robert Rubin, his Secretary of Treasury, did. And we had a surplus. We should have been that way the last few years, and we weren't. So that is really the problem. And Trump doesn't look at it quite the same way. He, as you know, if you look at his real estate career, he loved to borrow money and not pay it back. He thinks we can do the same thing with the government, but it's not true. And that's the worry. Do we scare the international world because of his presidency? He did last time. He's been held in check somewhat by the Secretary of Treasury, Basant, but this is a person you can't know what he's going to do next. So what is the market telling us? Well, for the last 15 years, the real interest rate, that is the TIPS rate, you get this rate to 11 plus a CPI adjustment each year. For the last 15 years, rates have averaged below 1% and 2 times they were negative. That means you got money free and you want to borrow as much as you can. And our industry, real estate, loves to borrow money. Trump loved to borrow money and not pay it back. Most real estate people would like to do the same thing. They do pay it back. Over the last 100 years, the average rate has been 2%. So we're normal now. And the last 15 years was abnormal. So I think we're going to be in this period of having to pay for the borrowings at a rate that's higher than normal. So here's the forecast that we do. And we have, at the Fisher Center, we have 228 members. They pay us money, but money all goes to Berkeley. They've helped with the big endowments here as well. And they come to our meetings at Pebble Beach twice a year to hear themselves talk. I talk as well, but mostly themselves, but some of our other faculty members as well. This time, the Chancellor, Rich Lyons, did a great job, a great speech. Carol Christ, the former Chancellor, did the same thing. And of course, when Rich was dean, he came down and spoke as well. And the deans have come down in the past. Obviously, Ray Miles did that a number of times for us, and Ann did the same thing. So here's the forecast we gave them, that if we find what we call the recession, the Trump recession, we'll have lower rates. And that's the offset to the weak economy. The forward curve, which is the market's consensus, has rates come down a little bit. They're 4.25 today, down to 3.75. And if we get the what I would call the optimistic scenario, we don't get a recession, that this turmoil ends in the next few months, I think rates go higher, but the economy is better. So lastly, before we take some questions, I think we have about 15 more minutes, so we'll take a few questions in a minute. But just to show you why inflation might be higher and why this could be a problem for all advanced economies around the world. The main one, and some of you took my course years ago, a few of you, demographics are something we spend a lot of time on, because demographics means the age distribution of the population and the growth of the population. And we have an aging population in the US and Europe, Japan, and China. We are going to have a chronic labor shortage unless we allow substantial immigration, mainly coming from Africa. But Europe doesn't want that. We don't want that, according to the latest plans. So if we don't get the population coming in from outside, we're going to have a lot smaller growth and even decline in our labor force. And it's true of all these other countries as well. And so that is going to put pressure upward on wages. We also have deglobalization. Free trade is no longer the primary objective. We have security and geopolitical concerns. We're putting barriers up and tariffs. Other countries have done the same thing. And it's going to hike the cost of everything we buy. And that's going to put pressure upward on inflation. Whether that becomes institutionalized, that wages have to be higher and we do all that, that's the question. Do we get a spiral? And that's what the Fed's very worried about. I have decarbonization here. That was the major policy that we've been following the last 4 years. That seems to have stopped. That green energy was expensive, but we were doing it. I think we're going to be back to fossil fuels at least the next few years. Defense spending surge is happening everywhere. Remilitarization of Russia, ourselves, Germany announcing big programs like this. So that is all money that's in a way wasted. It costs money to do that. And deficits, every country seems to say, well, we can do it as long as people will give us the money. But that's going to put upward pressure on inflation and interest rates. So I think we have, how much time should we leave, Jan, do you think, for questions? 20 minutes. So I'll do another 5 or 7 minutes, and then we'll do some questions. So commercial real estate, as you may know, has something called CMBS. That is, the banks originate a loan, but they're actually doing it with a mortgage market execution in the capital markets. And it became a big thing to do in the last cycle. We did $228 billion of that. It basically means you create a security and you sell it to the institutional investors. It's been in about the $80 to $100 billion range for some time, but it's a surging market again. And it is because spreads came in, they're very tight, and so investors, meaning pension funds, endowments, foreign governments, all buying these securities. And if you look at the blue line, the spreads have come in quite a bit. During crisis, the spread widens. In March 2020, it was COVID. February 2016, it was Chinese currency crisis. But we're almost on top of where we were in March of 2015. 3 weeks ago, we were right on top of it. But then the last 2 or 3 weeks, spreads have widened. Last week, they came back down again. So real estate can actually borrow in the capital markets through a banking intermediary. But there's $600 billion of real estate debt coming due every year. So that has to be refinanced. So every big bank, every regional bank has to deal with these issues. We've been pushing the can down the road. The problem is, if you financed 3 years ago, you paid 2 to 3.5%, 4%. Now rates are 5.5% to 6%. So it's a big negative. So everyone's trying to push the can down the road and not take back property. But saying that, if you own an office building, an older office building, you already have a lot of people giving back the property, almost a 10% delinquency rate, and that's the biggest issue for banks and regional banks. And the real number is probably double this. This is when you actually foreclose, and it's because people aren't back in the office in a big way. The other thing that we do in real estate is, why do we buy the property? What's the cash flow yield? And the cash flow yield for the favorite property types, apartments and industrial, about 5%, maybe 5.5% to 6% for some, and 4 3/4 for others. That's still pretty good attraction. And as you know, you can buy it directly by buying the piece of real estate, or you can buy it through a public REIT. In public REITs, you can get 4 to 5, 6% yield by buying stock in the companies that own the real estate. Retail's coming back strongly, but the yields are higher there because we had that period of indigestion. So I'd say 6 to 7% on retail. And then office, since there's a 23% vacancy rate, what is the right yield? We don't really know. There's a little bit of an upturn in volume of sales this year, but way below where we were during the peak of 21 and 22. And these are the returns people are getting. The yellow is the return for 2024. And you can see that, the yellow is 2022. The orange is 2024. Office is still, people are still not really making money yet in the office market. Remember, you get a return here from cash flow. So cash flows typically are 4, 5, 6%. And then you get a change in value here as well. So the only sectors that are showing substantial increases are hotels and retail. They're fully back. Apartments are not fully back, but are getting close to it. And same thing with industrial real estate. And lastly, we try to figure out where we are in the cycle for different types of real estate. So if you own B and C malls, B and C office, even A minus and B plus office, values are still weak. And also, many of our hotels in central business districts like San Francisco have gone into bankruptcy or held today. Their mortgage has been given back to the bank, so they're also not doing so well. Also, if you own life science real estate, it's already been weak. Vacancy rates went from 5% to 25%, and that's before the government cutbacks in NIH, NSF, all these things. So life science real estate is going to struggle for some time, maybe more than we think. Also, self-storage. Some of you may own some of those. they also got overbuilt. But other product types, depending on what location you are and what geography, some overshooting, but basically in equilibrium. And the preferred investment is data centers. Everyone seems to want to own these big data warehouses. They're being built everywhere to serve AI. I'm scared. When you have multi-billions of dollars, Blackstone's putting $100 billion in, others are putting all this money in because they think you require all the storage for AI. China has come through with a couple of companies saying, you don't need that. You need 1/10 the amount of space. So just like COVID started there, I think the less space will also start there. So I'm worried about this. But other product types, if you can buy things now at discounts to what it costs to build, the discount should be somewhere between 20 and 50%. Hold it for 2 or 3, 4 years. There's not going to be a lot of new building until we get rents higher. I thought I'd finally close with office. Office is the problem case in real estate. There's a huge amount of vacant space. Not much construction, but with not much employment either. We've had a flat environment the last 4 or 5 years. But the big news, and the big that worrisome to everyone who wants to get this market better, is that people don't seem to want to come back to the office. 34% of people, that's the employee, want to work at home 5 days a week. I have a simple word for that, FIRED. You're gone. But companies are tolerating it. Companies, 34% want you in every day. And it's in between, it's the hybrid. But I think it's better to be together at least a substantial amount of time for culture, casual interactions, coordination, collaboration, creativity, career guidance. I had our office on Thursday. I gave a free lunch. Everyone was there except one person who was sick. So maybe that's what you have to do, give them lunch every day. But it's a big problem for Silicon Valley and San Francisco. Much bigger problem here. And let me show you the numbers. We are the lowest percentage of people back in the office, 42%. Other places it's 60%, 70%, 80%. Amazon is requiring 5 days a week now. Many people, government employees, federal 5 days a week. San Francisco is starting, I guess now September 1st, 4 days a week. But it's really, I think it's very hard to work remotely for at least half your labor force. It doesn't work very well. I certainly find that with our little entity. But the real problem for office is the vacancy rate is so high. And availability means vacant space or space that people are trying to sublet. Highest in all of history. This is national, 25% almost. And it's just huge. And it's really hard if you own a building to have empty space not getting cash on that space. And the new space is being used. So Salesforce Tower is full. In New York, Hudson Yards is full. One Vanderbilt is full. But the older buildings, people are leaving. And this is unfortunate if you happen to own an older building. So what I think people are going to do is start converting those buildings to residential. It's already been happening in New York for a decade. But this looks like a very good possibility. And they've changed the rules and laws now to make it more plausible. No transfer tax when you do this. They're allowing, you don't have to have set aside for low and moderate income housing. So they're making it easier and easier to do in San Francisco. New York leads the way. I think San Francisco is going to follow. We had this conference a week ago Monday called Better Together that we sponsored, and a lot of owners there, a lot of city officials. So I hope this happens. It doesn't work for most buildings, but it does work for older buildings, especially of the right footprint and aren't too large. Don't think it works for the Haas school, though. I don't think this would be a place to live. It's a good place to work, though. So finally, office returns have been just miserable, the worst ever, and these probably understate what happens. So if you've got an older office building, it's too late to sell it, sorry, but convert it to residential use. Find a good group that wants to do that for you. Or if you're lucky enough to buy an old building cheaply, you can actually make money today at those prices. So I think, Jan, we'll take some questions. We've got about 10 minutes left, and I know we have a mic going around the room, and I will answer anything except my Trump relationship. So we have a question over here down in front. Yeah, down in front on the left side, right here. It's a hard room to do.
Thank you, Ken. George D. Uriosty, class of 1980. Sincere appreciation for the enlightenment and insights. One topic that you didn't touch on, the tariffs, while an assessment of the impact today, recognizing that there's a strategy and a motivation behind this, and that many economists seem, in my humble opinion, to ignore what the ultimate goal is. So in one scenario, where if Trump has a significant degree of success, where he gets foreign countries to lower their tariffs and non-tariff barriers to U.S. goods, and he replies in kind by lowering the tariff on them, potentially that's an economic benefit to our country, our society at large. But I've not yet seen many economic outlooks take into consideration the objectives of his tariff. And I think most people will agree, if the tariffs that he puts in place never change, then we're in for a bad scenario. But witness his 90-day pause, his claim that over 75 countries are negotiating. To what extent do you give consideration of that in your outlook?
Sure. So
thank you.
Let's talk about the traded goods sector. So 8% of our economy is in manufacturing. That's what he's focusing on. Turns out that Congress, both Republicans and Democrats, voted for a big plan, and 60 new factories are already being built in the U.S. So it's already been happening. No question that some countries have tariffs that are very beneficial to themselves and make it hard for us to export. So during his first term, and Biden kept most of these, they did do some of this negotiating. And if it's done correctly, and I don't see how you do 100 countries in 90 days, but if you could get reciprocal movement lower in tariffs, that would benefit us, no question about it. The big issue really is one country that's the big issue, and that's China. And China, there's no question, I've been there 5 times. I actually, we had a big office there. That all changed in 2016 and 17. They have taken advantage of the system, no question about it. And if he can negotiate that well, and it's not him, it's going to be Basant doing that, I think that could be beneficial, but it takes a long time to get the real benefits, because to build new plant, other things in the U.S., it's going to take some time to do that. China has become the preferred manufacturing for so many things. It's going to take a lag period of time. So how can we wait it out 2 or 3 years? That's the question. The goods that we get, so right now, and I've talked to them this, but 20 years ago when I met with them, they recycle all that capital. We definitely lost jobs in manufacturing in a big way, toys, other things. But to get the jobs recycled back here, it's going to take 2 or 3 years. So Basant has proposed phasing in and phasing out the tariffs and phasing in the new activity. Both Democrats and Republicans voted for this infrastructure renewal plan, and it's working. So I think the idea is right, but how to do it, the implementation, at least so far, seems like using a sledgehammer. Now, the president himself said he wants to use a scalpel. Unfortunately, the sledgehammer approach is what we've done so far. But maybe it will work. And that's why I have a 40% chance that it will work out. And we all hope it does. China's the big issue, and that's the big one he's working with. I don't know Xi personally, but he has got a set of sort of insular policies as well. So it's 2 people, are they going to get along? If you played golf, we'd have it all done right away.
Thank you very much. In your view, are the local and state governments being responsive enough to the vacancy rate in office in terms of changing development and changing zoning to accommodate new residential uses in those offices?
So, as you know, it is primarily a local government phenomena. San Francisco, to the real estate community's credit, has lobbied very strongly. And before Lurie was mayor, they were moving a lot of things in the right direction. He's been pushing as well. And so, according to my friends in San Francisco, the last change is being voted on this week, that it will make the incentives happen. But the big problem is property taxes. Property taxes are a big, important revenue source for San Francisco, 25 to 40% of revenue for many localities. And values are down somewhere between 10 and 20 and 60, 70%. And there's a big backlog in the reappraisal process. So San Francisco is facing, according to my friends there, we had the chief economist speak at the Berkeley conference we put on a week ago Monday, $880 million deficit out of a $13 billion budget. And that's before the reappraisal process. So it's a big issue everywhere in the country. And I'm afraid that the second tier effects, if we have to slow down the economy, in terms of state revenues everywhere, also going to be down. So who's going to put that money up? That's the question. You can't raise taxes at the local level at this level. And it's hard to borrow. So I think we're going to have a second round effect here, especially if we get the recession. That's going to mean just a period of time where communities are going to be very difficult to do that. But if you can convert office buildings that aren't full or not even partially full to residential and get the taxes, there's a benefit. So San Francisco is definitely moving in that direction, and I'm sure a number of other communities are as well. Berkeley probably won't do that, but that's another story. We got one up here.
Cal Blake, class of 2015. Is the delinquency rate in office, is that a danger to the financial system in any way? And if so, how might that interact with a possible Trump session?
Yeah. So I think that, as you know, in 2009, 10, 11, it was a huge issue. Real estate was the epicenter, and it caused lots of issues. We have, I'd say, 15 or 20 of the large banks as clients, and they say that they can deal with it. They changed the regulations in 2008, so a lot of capital has been built up. So the banking system, the large banks, feel that they can handle it. Even the Wells Fargo, which is the biggest issue, he spoke at our conference. He said, "We got a good handle on it, and we can take the losses, bleed them out over time." The question is, how about the regional banks and the smaller banks? And that's been a big issue. As you know, Berkeley has had the advantage of having Janet Yellen as our Secretary of the Treasury, and I had breakfast with her to talk about that, and she said that was her big worry. That was August. She's now no longer Secretary of Treasury, and we don't hear anyone talking about it anymore. So maybe it's not all there, but I do worry that there are several hundred institutions that, if you mark their portfolios to market, probably don't have any capital left. And there are some regional banks that we lost. We lost one of our, and you may know these people, I work with them closely, First Republic, one of the best banks I've ever dealt with. And we were advisors to them. And of course, they went upside down, and of course, against Silicon Valley Bank. But it looks like there's not a big flock more of that coming. Everyone I talk to says they're not thinking about it, not even worried about it. But Janet was, at least last August, still worried about that. Yes?
Hi, my name's Iona, class of 2015. I know you briefly talked about, during the Trump presidency, there might be a release of Freddie Mac, Fannie Mae. You had that slide from conservatorship. I guess my question is, what incentive would he have to do that? Because it's such a huge cash cow right now, both Freddie Mac and Fannie Mae. Right. I selfishly want that to happen because I'm a shareholder, but I was just curious what your thoughts are.
So the benefit could be reprivatization, $200 billion. That reduces the debt. One-time event, we get that money. So far, that's the talk of doing that. the head of Freddie Mac was on our board, the Fisher Center board, and I called her a week, two or three, about a month ago, and she said, it looks pretty good. We're going to be able to handle it all. A week later, she got fired. She was the head of PNC's real estate division, so she's conservative, but everything is in flux. I've talked to 7 to 10 people at different groups in Washington, everyone from the Fed to HUD. There's more uncertainty than I've ever heard, ever. And believe it or not, it shows you how old I am, Ronald Reagan appointed me to the Department of Commerce Advisory Council, so I know all the mainstream Republicans. It's complete chaos. That's not the way to do things. I don't think Trump wanted it to happen this way, but Elon Musk using the sledgehammer. And they pulled back some things. But I think there's a good chance it will happen. 2 of his big backers own a lot of stock, and it's probably the right thing to happen. What does it mean for the real estate market, though? Probably 25 to 50 basis points higher cost for credit, because Fannie and Freddie have implicit government backing. So I think there's a good chance it's going to happen. I don't know the new Secretary of HUD or the new head of HSFA, but I think there's a good chance that will happen. You know, we've only been 90 days, so we'll have to wait and see. But it's a big windfall that would help reduce at least a one-time reduction in the deficit. Yes, do we have a microphone? Right there.
Hi, I'm Paul Bieber, class of 2005. Thank you for sharing all your insights. We appreciate it. How much time do you think Trump has to affect some change with the tariffs before the economy goes into recession? Because obviously, if the economy goes into recession, it becomes increasingly probable that he loses the midterms and becomes hard to finance his deficit and his programs. So how much time do you think he has?
Well, he didn't ask me, but he has reached out to me on a couple of things, not him, but his people. I think he made a mistake. I would have done the tax stuff first, tax cuts, all that stuff, the pro-deregulation, all that first. Sort of put this on the back burner. But he did what he did, partly because of Stephen Miller and Navarro. These are very strong people. I love Lutnick personally. I know him, and he's extremely fair with me, but he just goes along with whatever's happening. Basant is the hope that he's going to postpone this another 90 days. I think it takes a long time to negotiate these things. And we did in this first term, some of them took, a year to negotiate. These are things that people are embedded with, companies are embedded, and a lot of people have a vested interest. So I think that he's got to change I would hope another 90 days, maybe even 6 months. Obviously, the market liked that. The market's up a lot last week. But I think the key is going to be what happens to capital markets. If we don't show some progress soon, capital markets might go down again. And we were in an elevated capital market situation. The Fed, clearly, Mary Daly can't speak for the overall Fed, but listening to that Fed members speak, they're on hold. They're going to wait. So I think he's got 4 more months before some of the bad data shows up. Right now, it's just sentiment data. There's nothing that shows up in the actual, a few things. Airfare, travel from Canada is down. A few things are down. But I think we haven't seen a lot of negatives. We had at our conference someone from Taiwan and China. He said shipments out of China are down 50% in the last 2 weeks. So if it starts showing up in shortages of the goods, price increases, it may have shorter time. But knowing him and working with, didn't actually work with him, we didn't take the job, but knowing his people, he's a flexible person, and he might well, postpone some of the stuff, because no one wants a recession on their watch. If you're going to do it, though, do it first year. Get it out of the way. So by the time midterms come out, we have recovery, and by the time the 2028 re-election cycle, well, maybe not a re-election cycle, but by 2028, you're on the positive side again. Remember, though, I think that the Democrats are also having their own problem. The middle-of-the-road Democrats, pro-business Democrats, are fighting the other side. So it's not clear that they're going to be able to put up a set of candidates who are going to defeat some of the stuff. We have some more questions. Can we move the microphone back? Right behind you.
I think we have maybe time for one last question.
Oh, you're not going to stop us.
I'm sorry. I think.
Hi, Ari, class of 2025.
Sorry. You're going to ask me after.
I'm wondering, what are your thoughts on, you didn't show any kind of like oligopoly effects being in effect on inflation, such as like housing or food or oil, and also in terms of response to China, I know that there's talks of getting rid of all types of like IP and patents potentially, which could have devastating effects. Do you think something like that could change the monetary system completely and like reserves in the US dollar?
Well, I talked a little bit about it. Housing inflation is back again, except if you live in Florida or Texas. They overbuilt. So rents are going up in 2/3 of the markets again, and new construction is plunging. So that's going to be a problem for, as you know, 1/3 of the entire index is housing related. So that's going up again. Oil is a benefit. We've had a benefit of lower oil prices, and I think that continues. We might, give him credit. We might get some deal with Iran. We might get Ukraine-Russia war ended. So I think those could be very big positives. So there are some real positives out there. China, I know, having been there 5 times, the people are entrepreneurial. They're just exactly business-oriented. So the question is, will Xi bend, or is he inflexible? Will he go over there, or he come here and get some big agreement? I'd say it's a 50% chance we will get a détente of some type with China. China will give back some of the things that they're taking in, because it's so important to tech industry and other areas. And I think I would thought of China as our ally in the world, and it was true until 2016. They were on our side, maybe exploiting us somewhat, but I think it's still up in the air. I think the uncertainty that the market shows and we all feel is out there. There's a lot of uncertainty, and I know that's not great for business, but I think there's as I said, 40% chance this all resolves positively, but there's about 60% chance it doesn't. And I think that's why the markets are so schizophrenic. I feel schizophrenic, and with the things his people have reached out to me, he hasn't. We couldn't help him with one. The other one, we might. I've got a call with them next week. It's how to monetize the closing of their embassies. How do they market that stuff? So there are positive things and negative things, and we just have to wait and see, which doesn't make any of you feel better, but go home and don't we have liquor later here? We always have that. Thank you very much.
Thank you, Ken.